What's up, traders? What's up, tycoons? Super excited for today's video. We're going to go over very important economic data. I'm going to break all of that down for you today. We're also going to go over treasury yields and do a TLT analysis. So be sure to smash the like button, subscribe to the channel if you guys are new. All right, these are some of the things that we're going to look at. These are some of the different charts that we're going to go over and break down in today's video. All right, this is a really nice one right here, the cheapest and most expensive ETFs. I really like this one. All right. We also have some data here about hedge funds increasing bets against discretionary stocks. So we'll take a look at the XLY ETF and just some more macro data, important data that I think you guys need to be aware of. We are going to break down treasury yields and take a look at the 10-year as well as the 30-year. And of course, we're going to break down TLT. We're going to zoom out a little bit, okay? And it says daily chart right here. That's my fault. It's a weekly chart, okay? And it's zoomed out so you guys can see the big picture here. All right. And then we're going to take a look at the daily chart zoomed in so you guys can understand and really, comprehend the analysis that I'm giving to you guys from a zoomed out and then a zoomed in picture. All right. I do want to mention that I started a completely free newsletter for you guys. It's called Investment Intelligence. It's really valuable, guys. Okay. It's free, valuable finance content coming straight to your inbox every single week. I give out free trade ideas in there. All right. One of them was Tesla a few weeks ago. You can see that Tesla trade worked out very nicely, especially if you trade options. ExxonMobil was another. All right, talking about ExxonMobil was at 111. Then you can see here recently it ran up to 117. All right, very nice trade there as well. And not all of them are long positions. Some of them are also short positions. This was a short trade idea from over a month ago, going over the rising wedge in SWK, which is Stanley Black & Decker, and showing the projections. And you can see how it played out very, very nicely. So if you guys are fans of free, valuable content, as well as free trade ideas, go ahead and sign up for that newsletter. All right. It's a great way to support the channel, help me grow my brand, while also giving yourself some free, valuable information. I do want to mention I started a Kofi page where here you guys can actually book your one-on-one personal sessions with me. Okay. I do 30-minute sessions and 1-hour sessions. I do those every single week. And I started using Kofi so you guys can come in here and actually have a platform to book them directly versus having to email me. Now, you can also come over here and you can use Ko-Fi to request a specific YouTube video. So if you come to the commission side right here, all right, that's where you can book this, the training sessions, the one-on-one sessions. That's where you can also request a specific YouTube video, right? Whether it's a specific ticker, stock, ETF, crypto, whatever it is, I'll take a look at it for you and give you guys my honest thoughts and opinions. Or if you want a video on a specific strategy or a tutorial video, I can do that for you guys as well. I do want to mention, if you guys are fans of the free valuable content I put out here on YouTube, you can always click on this buy a coffee button. It's basically a way to give a tip or donation and, show your appreciation for the content I put out. Now, what we're going to look at here is the U.S. 10-year yields. They have just risen back above global equity yields. So the global equity yield has risen just back above the U.S. 10-year bond yield. The equity yield here is the average of the world dividend yield and forward earnings yield. Okay, so when you take a look at some of these things and you take a look at some of these different periods, all right, and you can see basically the different types of environments, right? So you can see the recession here in the 90s. All right, you can see the recession here in the 2000s, right? And you see the recession here right around the great financial crisis. And basically we're just in trends right now. We're following trends, and it's very possible that this trend is trying to change, right? You can see that the US 10-year bond yield has been in a long-term downtrend here, right? And it's really breaking that downtrend. It's something very significant to pay attention to. And it's something that a lot of people, in my opinion, are overlooking, right? Too many people are overlooking the bond market right now when we're basically living in the middle of history right now when it comes to bonds and the bond market. Now, with the surge in interest rates again, earnings yield for the Russell 3000 index is now below 10-year yields for the first time in 21 years. So in orange, you basically have the 10-year yield. And then in the Russell 3000, you have the earnings yield. And so you can actually get a higher yield in the 10-year right now than the Russell 3000. And again, this is kind of just emphasizing the point that I'm talking about with, the bond market is something that too many people are sleeping on. And we haven't really seen what we're seeing in yields right now in decades, literally in decades. Now, when you look at the cost of capital right here, this is the increase since September of 2021. This chart, may be a little bit light to see, but what you really want to focus on here, okay, is you can see the 10-year treasury yield, going up. All right, the earnings yield for forward EPS, all right. Look at the downtrend in this, all right. These things have generally been kind of following each other, okay. You can kind of see that they're very similarly, all of these kind of following each other, and the earnings yield for forward EPS has just pretty much been going down, while you're seeing things like high yields, 30-year mortgage rate, the Barclays aggregate fund, and the 10-year treasury all really go up, and so that's what we're living in right now, is basically really since about November is when you started to catch the divergence, and all of these started to rise, okay, and the earnings yield for forward EPS has started to decline. When you take a look at the cheapest and most expensive ETFs, on the left, you have the most expensive right here. And on the right, you have the cheapest. Okay, now look at the PE ratios. All right, that's what this is right here, PE ratios. Okay, and each red dot is going to symbolize the PE ratios for the specific ETF. All right, and you can see in this, brownish, tannish color right here, this is the ratio of the price to earnings ratio versus the S&P 500. And then, of course, we talked about the red dots, the diamonds here being the valuation score. So what we're seeing is XRT real estate. All right. This is the worst, cheapest right now. And why is that? Well, commercial real estate has been something that many people are panicking about right now and really worried about that could break the economy. So it makes a lot of sense there. Now, to me, what's really interesting is iClean and TAN. iClean is a clean energy ETF. TAN is a solar ETF. Now, I actually like these ETFs. Okay, and these are things that I hold. iClean in my retirement account. And the reason being is because, in my general view, you want to follow where the money is going. Now, when I speak about the money, quote unquote, I'm speaking about government stimulus. Okay. And the government is really pushing the clean energy, movement in a sense right now. Okay. And, really the whole world is really trying to push clean energy and getting off of these fossil fuels. And there's lots of different forms of stimulus to a lot of these different clean energy type of companies. And, if you're someone that tries to invest with like an environmental factor or an ESG or something like that behind it, that's another reason why you may want to look at iClean. Now, utilities, okay, utilities are very, very cheap right now. And the reason, in my opinion, you're seeing this is because of the bonds, right? Utilities have kind of been seen as a safe haven, very defensive, and people tend to invest in them oftentimes, not only because they're defensive, but because oftentimes those are dividend companies and dividend stocks in the utility sector. Now, why would you invest in a dividend stock and worry about a price to earnings ratio, that's only paying a 3% dividend, when you can go invest in the bond market and get a 4% dividend, 5% or 4% yield, or almost a 5% yield, right? Especially on some of these shorter term, treasury bills and T-bills. It basically takes all of the risk out of it, right? And you can simply get that yield that you could get in utilities. You can get that in the bond market right now. And to my opinion, that's one of the reasons, at least, why we're seeing utilities so cheap at the moment. Now, you have KRE in here as well. All right. This is, everybody knows about Silicon Valley Bank and your regional bank. This is your regional bank ETF. So it makes sense that this is on the cheaper end. All right. Then you have the SPY, the S&P 500 ETF right here. And you take a look at the PE ratio, it's on that more expensive side, right? And as you go up, you see QQQ. Now, what's interesting is, XLF versus the KRE. So XLF, and I've mentioned a couple times, the performance there has been pretty surprising, right? When you take a look at some of the economic data and some of the bearish economic data, it shows you that, there might be a lot of financial worries. But what is the stock market telling you, right? How is the market treating it? How is the market interpreting the data? What does the market tell you? Well, it tells you that XLF is not doing too bad right now at the moment. Okay. Now, right above XLF, you have XLK. And then above there, you have XLV. And the most expensive is going to be SMH. This is your semiconductor ETF. Now, we pretty much all know the reasons behind that. Okay. It's because of the AI boom and mostly NVIDIA. being essentially the what some are calling the top AI play or the most pure AI power play. So that has a large factor, into why SMH is going to be the most expensive ETF. So I just wanted to break that down for you guys. Some people are value investors and some people want to look for good values in things like these, but that doesn't always translate into good performance. Okay. So you do have to keep that in mind. But when you take a look at some of the cheaper ETFs, maybe you guys can dive in here into these different ETFs and look at some of the individual holdings and see if there's a gold mine, something that you think is really undervalued that has great potential in the future. Now, hedge funds have been increasing their bets against discretionary stocks. And when you take a look at the cumulative short flow here for U.S. consumer discretionary, you can see in September it has absolutely skyrocketed. Now, this could be because they think that consumer discretionaries are going to tank, right? Keep in mind, when it comes to the XLY ETF, what are the two biggest components? Well, it's Amazon and Tesla, and they make up a majority of the XLY ETF. So there's a few different ways to look at this. This could be people saying that, hey, Amazon ran up too much, Tesla ran up too much, the valuations they're trading at are unreasonable, and so we're going to short those stocks. Or it could be betting on a recession, okay? And they could be saying, hey, well, we think that consumer discretionary stocks are going to perform very badly because we're heading into a recession. So we want to short consumer discretionary stocks. Now, the third alternative, if you take a look, is that this is just simple September seasonality. September historically is like about the worst month in the stock market. So if people wanted to go short, it's not like it's mind blowing to see short interest really, stacking up higher and increasing at a fast rate in the month of September. So keep that in mind as well. Now, this is the XLY ETF. And in my opinion, we're going higher. Okay. Now, maybe not short term, but ultimately, I think that the XLY can potentially head up to 187. Now, this may be at the end of this year. At the end of 2023, this may be within the first quarter of 2024. It may take until March or February or something like that. But, from what I'm tracking, we're looking at a 5-wave move to the upside. And we're currently in wave 4, and, essentially just working on our correction to the downside. Now, we've already hit the first target here of 158. Below there, we can go potentially down to 153.88, and below there, we can go to 148.04. Those are going to be some of the levels. Now, we really want to hold above here, okay? This 158.47. If we go down below here, it's very possible that we could actually end up getting a reversal and invalidate this 5-wave count to the upside. But we've done a pretty good job of basically staying above this 158 for the meantime. So to me, that's going to be a really important level. And ultimately a level that you're going to want to stay above is going to be that 158.47 if you're looking for that 5-wave move to the upside. Below there, things get a little bit messy, and it's very possible that basically this analysis that I'm following could become invalidated. Okay. So, now's not a time necessarily to rush into things, right? You can see we had a very clear false breakout, right? We had our trend line here, false breakout, a look above and fail, right? Looked above, we failed. I mentioned many times in my videos how this is a bearish indicator. It shows that sellers are in control. And what did we do? We actually created new lows here, a low and a lower low. So is the low in? Could things potentially recover and start this 5-wave move to the upside? Or could September seasonality spill over into October, and could we see more pain in the stock market during October and create new lows in the XLY? Now, the Goldman Sachs macro outlook implies the average consumer discretionary stock will lag the equal weighted S&P 500 by 7 percentage points during the next 12 months. Okay, and that's exactly what this chart right here is showing you. So if we look at it from this perspective, it's basically saying that we're going to come down and break through 158 and ultimately lag, right? And this could mean it starts trading sideways and just stays range bound between 148 and 158. Or it means that we could end up getting a reversal and break through 148 and try to retest some of our prior lows around 136 or potentially even 128. Now, this is not my opinion. This is from Goldman Sachs. Okay. So remember this, a lot of this, stuff is just data I'm presenting to you guys. Now, historically, when we talk about government shutdowns, they have not had a significant impact on the US stock market. All right. Now, when we speak about this, we're talking about during the initial showdown or shutdown right here. Okay. You can see the average is basically the average and the medium are positive 0.3%. So let's just call it flat. It's a big nothing burger. Now, 12 months after a shutdown ends, the average and median returns are 12% positive. Okay, so if we do actually get this government shutdown, historically, it's actually a bullish indicator for the next 12 months. So that'll be something really, really interesting that you guys need to pay close attention to, because we're going to have news on that very, very soon when it comes to the government shutdown. So you want to pay close attention to that. And historically, the data says it's actually bullish 12 months out in the future. Now, historically, the worst time to buy stocks is when unemployment is lower than 4% and rising, which is the current situation. Okay, we are right here with unemployment below 4% and rising. Okay, and you take a look at the gains versus the unemployment rate. It's doesn't look too good. Okay, essentially is what we're looking at here. All right, now once you're at these higher unemployment rates, or less than, okay, so like here we have greater than 8%, 7 to 8%, 6 to 7%, and you can see some of the historical gains within 1 year. And you can see really once you get above 5 to 6%, all right, you start to see 10% plus positive gains in the market. And where we're at right now, suggests 1 year from now that we could potentially only see 4% gains, which is pretty bearish. So it's really tough to decipher a lot of the data. I'm trying to show you guys a mixed array of data, right? This seems a little bit more bearish. This data right here seems a little bit more bullish, right? And ultimately, at the end of the day, it's up for you to interpret the data and, use this to help give you an edge and to come up with your thesis about the market and invest based upon your personal thesis. Now, one thing that's really important to me, I talk about the bond market and how, not enough people are paying attention to it. The 10-year yields have broken a decades long trend, okay, from, all the way back in the 80s here. It's, and really since the early 80s, we've been on this very significant downtrend, and we're breaking out, guys, here at the moment. And this is going to potentially, signal a long-term shift, right? Look at this period here from the 50s all the way up to the 80s. We had this crazy environment where yields were just skyrocketing to the upside. Now, I'm not saying that yields are about to skyrocket, okay, for the next 20 to 30 years, but is it possible that they levitate higher? Yeah, it very much is, right? I mean, they could just consolidate here for a few years, for 5 years, for 10 years, for a decade. They could gradually climb higher, or, they could really just, slowly start to decline. And it could take years and years and years for yields to get back to current levels, right? I mean, when you do a simple technical analysis, you have old support becoming new resistance, and we're breaking out past that. Okay, it's just that simple. All right, not trying to complicate things too much. Let's take a look at 30-year yields. Again, breaking decades long of a downtrend. All right, and we've already broken out past the 4.2 level, and we're coming and approaching very quickly the 4.8% level on 10-year treasury yields, right? Again, when you talk about some simple analysis here, right? Old support, all right, becomes new resistance, and now is the question, will this be resistance or will this break out to the upside and potentially try to go higher? Okay, that's something you need to think about. When we look at TLT, and if we take a look at a lot of these treasury yields and the bullishness in those treasury yields, it's very possible, okay, that TLT continues to head lower. Now, this is a weekly chart right here, not a daily chart, and it's going over a macro count with a 1 down, 2 down, a 2 up, 3 down, 4 up, 5 down, putting TLT right around the $80 mark. Okay, now that's not going to be at a very precise exact level. It could hit 81, it could hit 79. Who knows exactly, but when you take a look at things, the wave 3 hit the target extremely well, and then our wave 4 here was a little confusing at first, all right, but ultimately ended up being a triangle pattern, an ABCDE triangle pattern. And since we broke down, all right, our wave 5 should be a 5-wave impulsive move, and we've got our 1 down, our 2 up, our 3 down, and it appears we're starting wave 4 up, ultimately to have 5 down, back down towards that $80 area, which would complete the 5-wave cycle to the downside. Again, putting TLT anywhere from that $79 to about $81 price range. Okay. And when we zoom in a little bit more, we can kind of see this on the daily chart a little bit clearer when we look at the current wave count. So you have your 1 down, your 2 up, your wave 3 right here is supposed to be your strongest move, your largest wave in a 5-wave impulsive move. And you take a look at where 2 topped out right over here. You have 1 down, 2 up, 3 down, 4 down, 5 down. Okay. And that completed our wave 3. All right. It even extended past the 1.618 extension at 89.21. And so now we're looking for a bounce, but ultimately I think it's going to be a dead cat bounce, and we're looking for an ABC up. Now that could take us anywhere from, $91 to $90.50, right? I can't exactly give you guys the exact price levels. I can't tell you exactly where it's going to go to the top, exactly where it's going to go to the bottom, but I can give you guys a general summary and thesis of, my view on the market and where TLT is going. And now we're looking for this corrective move to the upside. Okay, but ultimately, I think it's going to reject, and we're going to get our next move to the downside, again, taking it anywhere from that $79 to $81 price level. So in summary, went over a lot of economic data in today's video. We took a look at the treasury yields and how they've broken decades-long downtrend and how we're in a completely new environment when it comes to treasury yields. And then I gave you guys my analysis on TLT, looking and zooming out on a macro weekly chart and then zooming in a little bit more on the daily chart so you can see some of the present day-to-day action. Hopefully you enjoyed today's video. If you did, smash that like button, subscribe to the channel. Don't forget to sign up for the free newsletter using the link in the description or the comment section. It's called Investment Intelligence, and giving out free valuable content every single week. All right, and reach out to me on Kofi. That's a direct platform to reach me directly. If you're ever interested in booking those one-on-one coaching sessions, one-on-one personal sessions, or you'd like me to make a specific YouTube video just for you, that's the platform where you want to do that at.